Good morning and welcome to the David and David on Real Estate podcast. We are today on episode number 150. Oh my goodness, what a round number. And what a great episode because we have Lena Gurgis coming back from New Venture Management. Lena, we're so excited to have you back. We had a great conversation last time you were on. We dove into some really amazing topics. We got such great feedback from those two podcasts that we recorded together that we really wanted to have you back and really dive in. There's so much to talk about. Welcome back to the David and David on Real Estate podcast.
Thank you guys so much for having me. I'm so excited to be back. And I'm glad that, we have some good feedback and not negative feedback. So that's great.
Yeah, we got so much to talk with you about. We're thinking of changing the name and adding you right in there. Make this part of your podcast too.
I'm down.
Maybe even top billing because you bring a lot to the table. So we're excited to have you back.
Thank you. Thank you. I'm very happy to be here.
And Lena, we're gonna dive into a topic that we haven't really talked about on this podcast, David, which is it's always exciting to have something a little bit different and something that we haven't really touched on before. And I think it's gonna be really exciting to our viewers because this is something that people are really talking about in our industry. It's a really hot topic item. We're seeing a lot of money move out of Canada and leave Canada and start flowing into the United States. And Canadians are waking up to this notion that there's more opportunities out there. So, Lena, I know you and your partner invest a lot of in the United States. I know you guys own a lot of properties, and we're really excited to kind of dive into this topic and learn more about U.S. investing today.
Oh, sounds fun. Absolutely.
So, where do
Um,
we start? Where do we start on this on this topic?
okay, so what I will say first, yes, my husband and I have been investing in the US. We've been in the Cleveland market specifically. So when I am going to share my opinions with you, they're mainly based on the experiences that we've had in that market because we haven't really been active in any other market long term. We've kind of dabbled into Florida. We've looked into the Carolinas and Arizona, Texas, but Cleveland really has been where we've been the last 12 years. So that's the first thing I will say. The second thing I will say is the grass is always greener. And we're going to talk about, why people want to go, why we went. And then we'll talk about why we're still here as well. We didn't liquidate our Canadian portfolio to move it into the US. We kept our Canadian assets. We just started adding American assets to it when the opportunity arose. And we started just as the US market had tanked completely and was slowly starting to climb up. So today's market is very different than the market that we started in. But depending on what type of an investment strategy you're looking for, the US is still phenomenal when you look at cost per dollar, when you look at your ROI, when you look at your cap rates. You don't see that in Ontario, especially. Um, so yeah, where do you want to begin? Oh my God, where can we even start?
So Lena, if I'm an investor and I'm
Yes,
contemplating going to the United States, what are the first few steps? What are the first
okay.
few things I have to think about? I have to sort of make notes on where do I start?
Perfect. So the first question that any investor, regardless of the market that you're investing in, should be asking themselves is, why am I investing? Are you investing to preserve and grow your wealth long term and you're stable, you've got income, you don't need additional income, and you're just looking to build a nest egg? Or are you investing for cash returns today, right? Because as a general rule, you don't get high appreciation and high cash flow in the same property. You get forced appreciation. So you can buy something that's got a lot of value add. You force that appreciation up front. But if it has cash flow moving forward, as a general rule, the appreciation is relatively steady. So you're going to see 3%, 5%, 6%. In my opinion, that's fantastic. But as Canadians, we're so used to seeing 20, 30, 15, 12 is considered like low appreciation that people are like, oh, well, this is a terrible like market to be in. So that's question number one, because that will determine the market that you go into. So we invest in Cleveland because we are cash flow investors. Our number one is we have to be in the black from day zero. On top of that, we are forced appreciation, BRRRR, whatever strategy they want to call it, because it changes over, the course of time. But we're forced appreciation people. So we buy distressed, we force that value up front, and then we cash in on the cash flow. We're not concerned too much about the appreciation annually. 5% for us is fantastic. And in my viewpoint, if my asset has maintained its initial value, I've paid it down using other people's money, which would be my rental income, and I've seen, let's say, $5,000, $6,000, $7,000 of net income every single year, why do I care if I only sold it for $100,000 more if I've been using my cash flow to invest wisely over the course of that time, right? As your income increases, you can then diversify into those higher appreciating, lower cash flowing markets. But if you're, strapped at the moment, don't go for that high appreciation in places like, Florida or Arizona or California, where you see these huge spikes. But just like Ontario, you might be putting money out of your pocket every month. If you're a doctor, a dentist, a lawyer who can use that type of tax write-off, go for it. Like, have at it. Take advantage of what the government allows you to do in order to mitigate and minimize the taxes payable. But what are you investing for? That's number one. Number two, how are you going to be investing, right? So if I buy property in my personal name, a lot of people that I have spoken to, I don't want to give this as a general blanket because I only know so many people. We've got 7 billion people on this planet. But the people I speak to, first thing they want to do is they want to invest somewhere warm. They want to go to Florida. They want to go to California because the weather is great. And they're thinking about it from the mindset of, where can I go on vacation, write off, my expenses? And that's great. But again, is this now an investment or is it a hobby, right? It's like a lot of people during COVID who bought cottages because that's where they wanted to, oh my God, what was that word? I've been so traumatized, I can't even think about it. Quarantine and isolate. And then they thought that they were going to be able to then flip these into really profitable tax, or not investment strategies. And they didn't think about the tax implications and everything else that came with it. So this is also important. Why? And why are you buying? Are you buying because you want a vacation home that maybe you're just going to cover the expenses for? Or is this now a business? Because if it's a business, how you want to structure yourself is going to be very different as well. If you need to be paying yourself from that business, if you're hoping to be able to bring investors into that business. So this really needs to be kind of laid out in the beginning. And it's very important that you're talking to people who actually have done it. Because right now, unfortunately, there are a lot of people who have groups and companies that are in the United States who do this, that are talking in their ear saying, hey, I'm going to pay you 25% commissions if you can bring people to invest. And they talk about all this great stuff, but they've never really done it. And you kind of sit there and you're like, but wait a minute, are you sure? So make sure you're talking to people who have been there, done that. But you really need to know why. What are you doing this for? Like, really why? And it's not just because it's sexy to be in the US.
So I got a question for you. Just, you pick Cleveland at some point, and
Yes.
you talk about, but you're going in looking for distressed properties.
Yes.
Okay, and I assume we're talking about residential properties here, right? We're not talking commercial.
So commercial residential, yes. So like as an example, right now we're evaluating an 11-unit building. Half the plumbing's missing. It's got a new roof. It's fantastic. But it's strictly rental. We don't buy retail, office, things like that yet.
Right. Okay.
Maybe down the line, but right now residential.
Okay, so by distressed, maybe explain
Yes.
what you mean by distressed.
Ooh, okay.
Like is this, you're buying it at a lower price because it's distressed, in quotation, but that usually means, and in addition to our purchase price, we need a bag of money to fix this place up in order to rent it out at reasonable rates.
Absolutely. Right? Okay, so we can do distress in a few different ways. If I was just starting out, so again, we've been investing in Cleveland for 12 years now, and we are now looking at an 11 unit building. Half the plumbing is missing. It's completely vacant. It needs, probably $300,000 worth of work on a high estimate, because we're going to assume even the work that was done needs to get redone. I would never start with that if I was going into a new market. What we started with, interestingly enough, we were the money partner. We weren't even like the active investor in that particular situation, but how we started was single family homes. At the time, we were purchasing them for like $20,000. It was ridiculous. And they needed roughly $10,000 worth of work, and the work was always cosmetic. So when I say cosmetic, there were holes in the wall, but the plumbing was still there. The electrical was still there. And I say this because in Canada, we don't see it often, but in the US and Cleveland, for us especially, if your house has been vacant for 30 days, somebody's gone in there and stripped the copper, stripped the aluminum, like you're going in there and it's just gone. Everything's gone. Your furnaces are gone. Your hot water tanks are gone. Done. I've seen windows gone. So it's a very different.
I think they call that the American dream.
Yeah, it is a dream, let me tell you. But you start with cosmetic distress, because cosmetic distress is relatively affordable. US labor costs much less than Canadian labor. Materials for quite some time were much less in terms of cost. They're a little bit more comparable these days, I would say, but the cost of labor is still a lot cheaper. So I can cosmetically redo a 3-bedroom home, paint, new carpets, a new kitchen, a new bathroom for $15,000, $20,000 maybe. So now I'm $40,000 in and I'm renting at $1,200 a month. In today's dollars, that 40,000 is probably a little bit closer to 75, let's say, but you're still renting at $1,500. Not a bad payday. But that is what we talk about when we talk about distress. We're talking about properties that, and the reason this is important, you want to look at properties that an end user American, so an American homeowner, would generally not be able to qualify for. So most end users do not have the ability to purchase a property cash, spend on the renovations, plus cover the costs of living while that's all getting done. So they're happy to pay for a completed product that they can then go and get a traditional loan from an American bank and do that traditional kind of American homeownership thing. So what you'll find is there is a market, especially for the end user, where you can find single family homes that can't be financed because they don't cost enough. Banks won't do it. That require minimal work because the structural, like the foundational items are there and they're in good shape, and you can quickly clean them up and sell them to an end user, make your money and go. So when I say distressed, I'm talking about that. We're not, I mean, I shouldn't say we're not, we do, but I wouldn't recommend going in and buying, a 6-plex, let's say, that's filled with sketchy individuals and, people who make not the best life choices, because even that environment is different in the United States. People in the US, generally speaking, we don't have the same, so we go A, B, C kind of D level neighborhoods. In Canada, we kind of stop at an American C. I would say that we don't even have a C- in some of the markets that the US does. Forget about the Ds. And when you have C-, D class neighborhoods that we as Canadians aren't even used to seeing, if you go and buy distressed in those areas today, even today, with the experience I have, I wouldn't do it.
In Canada.
Yeah,
Canada, we don't even have it.
Right.
But over there, if you gave me a building and you were like, this is free, but it's in like East Cleveland, which is a D-class neighborhood, I'd say, thank you, enjoy, have fun. I'll see you at, the next one.
So are you buying these properties from a bank, like under a power sale, as opposed to from an owner that, like, the owner's gone, it's vacant, they abandoned it because they couldn't pay their mortgage, or who are you buying from?
Okay, so few combination. Number one, in Cleveland and in most of the American states, they don't have power of sale. This is why you can get things dirt cheap. Everything's a foreclosure. So you hand in the keys to the bank does whatever they want to do, you walk away, hands are clean. In Ontario, we do power of sale, which means that the bank is obligated to sell at fair market, and whatever the difference is, they come after you. So the banks here will generally not give you a very good deal. Over there, sometimes we have done auctions. So we've done auctions that are like foreclosed auctions from the banks. We've done auctions that are due to tax sales. We personally prefer to kind of get into it before it goes down the level of the bank, because once it's been foreclosed on, that's where you generally find windows missing, hot water tanks missing, because in that interim period, because it's not a short process, things get stripped. So our preference is to work with wholesalers in our markets who are able to identify these problems before they become long-term problems. And I find for us, this has worked because we're still getting a good deal, but the amount of output in order to collect that appreciation is a lot lower. And we've actually been successful in a couple of instances where we've actually been able to come in and partner with the current owner. So they've been in default. We've been able to come in, catch them up, bring in the work. We offer them the price that the house would be worth at the time. But instead of coming up with all of that cash up front, they continue to stay on as our partner. And then we walk away with the difference, and they walk away with their credit intact without the loss of their equity and whatever else might have been. But definitely, if you can connect with people on the ground, and there are a lot of agents, like real estate agents in the areas as well, who know of certain things that are coming up. They've got people like in the city, they've got people in the banks. One thing that the Americans have that we don't, they have local banks. So the community banks and things like that. So those small banks become almost like your little neighborhood hub. So the really good brokers, the good agents, these people all know the loan officers and whatnot in these small community banks. So they already know what might be coming up. So before the bank has taken back that property, they may talk to one of these agents, one of these brokers, and say, hey, look, like we've got this situation. Do you know anybody who wants to come in? Because we really don't want to deal with this. Banks are not in the business of owning real estate and selling real estate. They just want their loans and they want to get the heck out.
Yeah, there's a fundamental difference in their system, and it's not in every state, but it's predominantly different. Canadian system, the US system. The mortgage loans on residential properties are non-recourse loans. So that's why when they're in default, the borrower says, okay, we can't make it anymore. Here's the keys, Mr. Bank, and we're gone. And the bank forecloses on the property, they take it over and they can do what they want with it, but they're not chasing the borrower for any shortfall, which is completely different from the Canadian system, where the banks always have the right. There's always it's with recourse, so they can sell the property for what they can, and that's why they sell for fair market value. Because after they sell it, they can still chase the borrower for any shortfall, no matter where the borrower goes. So that's a fundamental difference. That's why in our country you're seeing more power of sale, because they don't want to give up the right to go after the borrower for a shortfall. And in the US, it's foreclosed because here's the keys, goodbye, we're out of here, we're going to go try something else. So it's a fundamental difference in our systems.
Very much so. And I mean, there's a lot of differences in our market versus theirs. And I think one of the reasons why a lot of investors are leaning towards the United States is because Americans as a general whole take a lot more risk. They're much less risk adverse than we are. So they're okay. It's like, you know what, we're going to lose 10 grand, whatever. Let's give it a try because I might make 100. Here, it's like, oh, I could make 100, but oh my God, what if I lose $1,000? And we really don't want to take that risk. And over there, it's like, it is what it is. Who cares? And because of that, things move faster. But also because of that, the standards are different. So as a Canadian, if you're going into, let's say, the US market, you want to start flipping houses. If you want to start flipping houses in Cleveland, please don't flip them like you would here. Like, don't waste your money putting in laminate flooring and hardwood flooring unless you're selling some high-end end user product. Entry-level homes have laminate countertops, they've got carpets, and people are happy. People are happy. The standards of finishes are different, the expectations are different, as is the work ethic and who it is that you're dealing with. So be prepared for that as well. There is quite a difference in mindset. So if you are looking to go into the US, one of the things I will say is it's not a passive investment unless you have just written a check to the active investor. If you are that active investor, it is an active job. You really need to manage your people, because over there, if you are not on top of them, these cowboys have kind of gone off and done whatever it is that they want to do, and oops, sorry. And we learned that the hard way. We learned that the hard way, but you really, really need to be on top of them, because it's just they're used to just kind of going with the flow.
Okay, so now you've fixed up the property and now you've rented it out. And now
Yes.
you're a landlord, you're putting your landlord hat on. What type of landlord and tenant laws are you running into there compared to what we are experiencing in Ontario?
So first thing I will say is Republican states and Democratic states are very different in terms of their legislation. I would say from our experience, the Democratic states are very much similar to, and or possibly worse than Ontario, believe it or not. Like the state of New York is way worse than we are here all day, every day. But Ohio, as an example, is generally a Republican state. And we have a 10-day eviction notice. And from there, you file with the courts. And from there, the courts will issue an eviction. It sounds spectacular. In theory, it is. However, the difference here now is when I start that process in Ontario, I've started the process of eviction for non-payment. I can collect payment until the day of my hearing if there's still money owed. And it could be $5 and I am still legally entitled to my hearing. In Ohio, if I collect $1, they owe me $10,000 and I accept $1, my entire process starts all over again. So imagine if you're not aware of this, if you are in a situation where, let's say you're a little bit strapped for cash flow, somebody owes you $5,000, they're offering you $2,000, and you accept it because you have to pay your bills, you have to start all over again. In Ontario, I can take that $2,000 and I can still evict you. So that's the first difference I would say. The second is, again, this is strictly in the county that we're in. You have to register your rentals. So post-COVID, there was a backlog for registrations. So if you had a tenant who was in arrears, you can't file with the courts until your registration is complete. But if there's a year backlog on registrations, you have no control over it, and now you can't file. So what should be, let's say, a 2.5-month process has now turned into an 8, 9, 10-month process. So it sounds great in some senses, and it is in some senses, but there's still, inefficiencies. There's still kind of hidden terms and conditions. But some of the great things that we have over there that we don't have over here is there's no rent control. So I increased my tenant's rent by $300 a month this year. And it was because we hadn't increased it the year before, and we had already allowed her into the unit at the time at a slightly lower than market rent because we wanted to be competitive. $300, no questions asked, no justifications. Number one, fantastic. Number two, if I don't like my tenant, we don't get along, I don't like the way you behave, I can give you notice 60 days prior to the end of your term and say, hey, guess what? You need a new house. You're not renewing here. And they have to leave. There is no automatic renewal. So you're only stuck with them, let's say, for that 12-month period. You are in control from that perspective. Now, I can't do that in New York State, right? I can do that here in Ohio where we are. So I don't like you, I'm going to go through. So every year we evaluate what the market is currently looking like. We evaluate what our current tenant profile is like. And if it's not a match, we let the property manager know, you know what? Sorry, we're not renewing. Just let them know. Don't do it to increase rent by $200 a month. because you still have to clean the unit, you have to pay the property, you have to do all those other things. You're not going to make your money back. But if you have a tenant who's consistently late, you have a tenant who's not taking care of the property, it's just thank you, no thank you, we're not renewing.
Yeah, that's a big difference from what everybody experienced.
Huge.
No
You
question.
are in control of that asset. You're not married to them. And that's another reason why when you get a tenant who's like, I want to sign a 5-year lease, you're like, no, sorry, thank you, no thank you.
Those are
12
generally
months.
one year leases, but it doesn't
So
automatically become a month to month at the end.
exactly. Exactly. So what we do is we go the first year, we let them sign for that first year. And after that, it's just a month-to-month renewal. Like that's it. So we allow you to renew. It's going to be a month-to-month term, and we're going to see how it continues. And if they've been great, let's say for that period of time, and they ask for a 12-month because they want the security, we'll do it. And if they're not ideal tenants, we won't.
Yeah, and
Wow.
you want to get them out, you can really get an eviction order in a
We
row.
don't need an eviction order. We let them know it's not a renewal. There's no renewal and you need to go. Your lease is done. You're not allowed to be here anymore.
And if they
I don't need the court to
go,
tell me it's okay. Here
no,
I do.
but if they refuse to go, you got to get
Oh
someone
yeah,
to bring them out.
yeah,
Right.
yeah. But it's a much quicker process.
Right.
A much
Wow.
quicker process.
So many
And
differences.
generally, from our experience, we haven't had people who want to stay.
Right. And Lena, you're purchasing a lot of these properties in cash. What
Yes.
happens if you're a Canadian contemplating going to the United States? What happens if you don't have the resources to be buying these properties in cash? You mentioned at the beginning that this was about 12 years ago that you started. Prices were a little bit
Yes.
different. They've risen now. What happens if you don't have the resources?
Okay. So first things to note is American banks as a general whole won't finance anything that doesn't matter the condition. They won't finance anything that sits at less than like $100,000, let's say $120,000 value. So the first thing is if you don't have, let's say, the resources, you have to go into higher priced units. Number one. Number two, the banks in general, even Canadian banks, they're very adverse to lending on distressed property. So if your property needs a substantial amount of work, it's not a property that can be occupied immediately. They're not going to lend to you, right? So the pool that you're looking at becomes a lot smaller, right? You're not going to be looking at those high ticket value ads. You're going to look at something that's a little bit more turnkey. Your ROI is going to be slightly lower, but it will be something that you will more than likely be able to secure some sort of financing for, depending on how you're structured. In my opinion, if you have the ability to partner with somebody else and pool those resources and purchase in cash in the beginning, there are markets that will lend themselves really well to that. And it's not a substantial amount of cash. Now, again, we're looking at investors here in Canada. We can't buy anything here with less than 20% down. And I'm not aware of very many opportunities that we have here for less than even $500,000, let's say. So if you've got 20% of 500,000, that's 100,000 Canadian. 100,000 Canadian will allow you to purchase something in cash. Let's say, the Cleveland ad. Oh yeah, in Cleveland, absolutely.
Wow.
Absolutely. Absolutely.
So
So
$100,000 in cash Canadian, that's about 65,000 US if my math is correct. So you're saying that for 65,000 US, you're able to find a cash flowing positive property in the Cleveland area today.
So you will turn it into a cash flowing positive property, right?
Gotcha.
So there are areas. So we've got one of the first properties. So we ended up in Cleveland because we had to foreclose on a couple of the properties that we had been lending on. We did a whole bunch of transactions, and unfortunately, our active partner purchased an area she was unfamiliar with. All hell broke loose, and we had to foreclose. So one of those properties that we purchased is in, let's say, a C-class neighborhood. Our lawyers out in the US are like, don't go there without a bulletproof vest, like you don't want to be there. It's not that bad. It's really not that bad. Even today on the street that we're on, you can negotiate. That's not what the price is going to say, but you can negotiate down to roughly $40,000 your purchase. and you'll spend roughly $20,000 to fix it up, and you'll rent it for $1,500 a month.
Wow.
Yeah. Even today, that 11-unit building that I'm talking about, we're negotiating like a price of less than $200,000.
Oh my God.
Right? Because it's distressed. You know what I mean? Nobody's going to fund you. Like, who on earth wants to redo 11 apartments on top of plumbing, on top of electrical, on top of windows? It's a large investment, let's say, but you're renting, let's say, 11 units at roughly $1,000 a month, and I'm being conservative. So for, let's say, a total of $500,000 in, and now I'm being generous, you're looking at $11,000 minimum of income monthly. And once it's done, getting a loan on that is not going to be difficult. So you pull some
You
of
get
your
your money
cash
back.
out. Yeah, I mean, so if you have the ability to partner with individuals who have similar mindsets, goals, and whatnot, and you guys can go in there, there is opportunity to purchase because we need a lot in terms of a down payment. Our down payments here will buy us there in cash. We're not looking at 800, 900 million dollar properties. You can if you want to, absolutely. Getting financing for those is definitely a lot easier in the United States as well. But they can't be distressed. They have to be not turnkey per se, but they have to be operational.
I got a question here because our Canadian government in their wisdom thinks it's a good idea to ban foreigners from investing in our country on residential property. There's no equivalent of that in the US. So you're now a Canadian investor investing in US properties because you don't have a ban on foreigners because now we're foreigners, right?
We are.
So you can do it. But are there some other tax implications or anything like that that everybody should be aware of because we're foreigners buying property in the US?
Absolutely. Okay, so obviously as a Canadian resident, my income is taxed globally, right? So the government of Canada requires that I report all of my global income and then they want their share. We have a tax treaty with the United States. So basically the IRS and the CRA have agreed that Canadians who invest in the United States and the Americans who invest in Canada, whatever income they have, each government will take their share, but their home government will only tax them to whatever their tax is. So if my tax bracket in Canada, let's say, is 40%, and I've already paid 30% tax, let's say, to the IRS, because that's the tax rate in the state that I'm in, the CRA will collect the additional 10%, right? They're not going to tax me again 40% because we have a tax treaty. This is if I own it personally and I'm collecting the income personally and I'm claiming this on my personal income tax. I pay whatever rate my personal tax rate is minus whatever I've already paid to the IRS based on what it is that they have. So a lot of Canadians have been advised that in order to maximize the tax advantages that you have, you want to set up an LLC, let's say in the United States, you're limiting your liabilities and now you're getting tax advantages, but they only get half the story. So they create an LLC and either they hold that personally or a Canadian corporation holds it. And nobody tells them that the CRA doesn't view an LLC as a taxable entity because in the United States, it's a pass-through. So your LLC, you know, is getting taxed, you're getting taxed, everybody's getting taxed, even if, let's say, there were taxes paid, because it doesn't really count, let's say. So it's very important that as a Canadian, again, it comes down to why are you investing? Yes, I want to make money. Am I planning on bringing money home every month? Am I planning on bringing money home every year? Can I leave my money there to work for the next 5 years? These things will determine how you're going to set yourself up. Am I only buying on my own, or am I going to be bringing other partners with me? Because how I structure myself will be very dependent on that as well. So it's very important to really identify that why, because when it comes to tax law, I don't know if it's been your experience, but I find that like there's a lot of room for interpretation when you're you. And then when CRA is there, it's like, no, this is what it is. And I don't know how you didn't see that. And once they've decided kind of changing their mind is very difficult. So it's important to speak to American tax specialists in the United States, as well as Canadian American specialists here in Canada. So people who can look at you as a whole and say, okay, these are the things that you're doing. As a Canadian, these are the things you want to consider. So let's set you up this way as an American entity, maybe. Or you know what? It's great. Go out and buy your own name. I will say one thing. If you are buying investment property and it's not vacation property, like you're investing in rentals where the people are going to be living there, you are never going to occupy that space. There's no part-time anything. Maybe, if possible, please don't buy it in your personal name, right? The US is very litigious. You do not want somebody being able to sue you and causing problems for you personally. You want to have kind of that shelter of, not being able to pierce your personal veil, for lack of a better word. We're not as litigious here in Canada, so that asset protection portion isn't as fundamentally important as it is over there. So if it's not a vacation property, if it's not something you are going to be using part-time, please, if you can, please don't buy it in your personal name. Set yourself up, whether it's with C Corps and LLCs or GPLP structures, whatever that might be, depending on how you're doing it. Make sure you have some protection between yourself and any potential lawsuits.
And Lana, from my understanding, and you can elaborate on this a little bit, but the income qualification to buy investment properties is also very different in the States because they don't look at you as a whole and your whole portfolio as a whole to see what the debt service ratio is. They look at the property and only the property itself to see how that property can service the outstanding debt. And to me, that's the genius of investing in the United States and a huge differentiating um, you know, factor between the two countries.
So yes, now I will say this, as a qualifier, I don't deal with our mortgages. My husband does. So the information I'm about to give you is based on my own observations as well as some secondhand information. However, we're in the process right now of actually refinancing a single family home in Cleveland. Everything we own is owned through American entities. So it is an American entity that is getting this loan. And the only thing that they've asked for is a copy of the lease, proof that the payments are actually coming in. So it's not just send me a lease. You have to show me from your bank records that the money is actually coming in, and an appraiser. And based on that, now we're only going to, like, max we can get is 65%, but who cares? We paid for it in cash. And if I'm getting 65% of my cash back out based on my new value, not my actual cost, yay. We chose to go with 60% because this particular institution at 65% required us to have roughly $10,000 of cash sitting in the bank in order to close the loan. And we were like, yeah, we don't need to do that. We'll take a little bit less, no big deal. And then I don't have these requirements. But it's a relatively painless experience, but our interest rate is 7.55%. So for some, that would be like the end of the world. For us, our first property purchased in Canada, the interest rate was 7.89%. We're used to it. It's not about the cost of the money. It's about the terms of getting that money and what you can do with that cash. So if I'm freeing up, let's say in this instance, $120,000 US, I can take $120,000 and I can flip it and make 50K, let's say in the next year. And I'm being conservative.
Or buy an 11-unit building that requires more money that's going to give you $11,000 of cash flow coming in every single month, which is going to turn into almost an infinite return. But going back to the 7.5% on that mortgage, Lana,
Yes.
The beauty there is that it's a 30-year amortization and a 30-year rate. So as an investor, you have stable and predictable income coming in for the next 30 years from this asset without worrying about renewals, without worrying what's going to happen to the market, without
Yes.
worrying what the interest rate's going to be. And as an
Yes.
investor, especially one that's, investing for the long term, that's a beautiful situation to be in because you have
Gold.
very predictable income for the next 20 years.
Gold. One of I think the biggest setbacks that we have from a mindset perspective as Canadians is this thought of like, oh my God, interest, interest, interest. Like 1% is the end of the world. How dare I ever pay so much more? I think we lose sight of the fact that number one, that interest is a write-off against the income that we're generating because this is an income producing asset that I'm purchasing. It's not a toy. It's not a hobby. And number two, it's the power of having that leverage that will allow me to continue to generate income, which should offset the cost of that interest anyway. So I've had conversations with Canadians who view that 30-year as a negative. They're like, oh, but what if the rate goes down? So what?
Yeah.
Number one, it's not like you're married to this bank for 30 years. Just like we have penalties when we break the terms of mortgages, they also have penalties. And when you break the term of your mortgage, you pay the bank and you move on if it's really that big of a difference. And interestingly, you get to
Even that
negotiate those.
penalty, sorry, Lena, even
Yes,
that
go ahead.
penalty that you paid, if you're, to get out early, that would be a deductible amount too, I assume, too, because it's an investment property.
Yeah.
And it's also a non-recourse loan,
Yeah.
right?
Yeah.
So you're getting this mortgage as a non-recourse loan. So if everything really goes bad, you're
Hand in the
saying to the
keys.
bank, here's the keys, and I'm doing something else.
Hand in the keys, shut down the LLC. Thank you very much. Have a nice day. I'm really sorry I and it sounds so horrible, but it's true. And I'm not saying this because, this is what I would encourage people to do. But when you know that your risks are not as high, you generally make less emotional decisions. And interestingly enough, when your decisions are a little less emotional, they generally become a lot more successful. Like we haven't had situations where you look at it. So we've been through how many presidents now? I think we've had Obama, we've had Trump, we have Biden, now we have Trump again, right? So we've had a cycle of very different views that have gone through our markets. And every president brings with it a little bit of volatility in the beginning, and then there's some stability for some instability for others. But as a general whole, we've never been in a situation where it was like, oh my God, we're gonna lose everything. Oh, game over. Oh God, that's it. We're done. No, we've had situations where, so with the interest rate, the kind of things when the Canadian rates went up, so did the American rates. And we were in the middle of a flip that unfortunately was not going to sell for what we wanted it to sell. So we rented it. Oh, boohoo. I have 100,000 locked in. Gosh darn it, I've got $1,600 a month coming in. And now I have to get a loan from the bank to get my money back. Not a big deal. I don't have that same security. Let's say if I were to be trying to flip something in Hamilton, because if I'm $1 million in and I'm only getting 80% financing and I thought it was worth 1.5 and now it's only worth 1.2 and I'm only renting it for $3,000. Where is that difference coming from? So we don't have those same risks that come in there, and we get stuck on very different, very, very different things. It's okay. You're going to pay a couple, you'll pay $1,000, $2,000, $3,000, whatever. I have paid $50,000 in penalties to CMHC in 2009. $50,000. Like it happens. We survived. It's okay. As long as the money is working and you're making intelligent decisions based on the return, not how pretty the house is, not how many times you're going to get to fly to Florida for, free because it's a vacation, but it's business, you'll be okay. The markets are phenomenal, in my opinion, if you're making sound decisions. But we have those opportunities here as well. Like I want to put that there. I'm not here to tell Canadians to take all your money and put it in the United States. We have a bit of a correction that's been happening here. So with this correction comes an opportunity to negotiate. And with opportunities to negotiate, you have opportunities to get into deals today that in 5 years are definitely going to be worth more. you're going to have that kind of money on the buy. And there's going to be these opportunities because there are a lot of people who are financially strained. And I don't think you see as much of that in the United States, unless it's stuff that, you know, they ran out of money. They can't pull money in because the cost of money now is expensive. So they can't finish the project. That's really what you see a lot of in the States. Here, it's more, I'm over leveraged. I can't afford my payments. I just need to get out before I lose everything that I have. How can I just come out square? I don't need to make anything. I just don't want to lose everything. And with that, you know, there is opportunity to be had.
Yeah. Love that, Lena. Well, listen, you've given our viewers a lot to think about, and you know, so many different uh, things to consider. But like you said, there's opportunities on both sides of the border. And you know, I hope that our listeners, you know, explore some of the opportunities down south. And if they have any questions, can they reach out to you for advice as
Absolutely.
well?
Absolutely. And then the stuff with mortgaging and things like that, you can talk to my husband. He'll give you proper answers.
Awesome. Well, this is an amazing episode. Thank you again for coming back and you know, really enlightening us with your wisdom. And it's been a great conversation. And I hope a lot, you know, our listeners take you up on the offer and look at the United States as a valuable investment opportunity and explore what lays down south.
I thank you so much for having me. Definitely explore the options, scatter your eggs.
Awesome, Lena. Well, thanks for joining us. We'll have you
Thank
back
you.
on the next episode where we're going to get talking a little bit more about investing back in Canada and some of the hot topics that we're seeing in our local market. Thanks for joining us, and
Thank
we'll see
you.
everybody next time.